Welcome, guys. Welcome to the webinar tonight for Fannie Mae's new DU update. My name is Natasha Robinson, MLS number 332074. I am your loan officer, and I wanted to come to you guys tonight, 911. I know this information came out last week, so I wanted to come and get you everyone together so that way we could talk about the facts and the details and the things that you need to know. So just going to give everyone maybe a few seconds while everyone's coming in. Just wanted to let you guys know there are no rules when you are on a Loans by Natasha Zoom. Feel free to ask any questions in the chat. I do have my team online ready to get those questions out. If for any reason we don't get to your question or you think of a different question later, you can always email me at natasha@grarate.com. If you are watching on social media, you can also DM me and we will get back to you as soon as possible. All righty. So let's talk, guys. Let's talk. Everyone's hearing about Fannie Mae, no credit score. And it sounds super exciting. And it is exciting, right? It's exciting because we are in a market right now that is unpredictable, right? We don't know exactly what's going to happen, but we know we have to purchase real estate in 2025. We know we have to sell real estate in 2025, but we want to make the best decisions for our family. And the way you do that is to become educated like you are tonight by tuning into my Zoom. And once again, my name is Natasha Robinson. I am your loan officer, MLS number 332074. Please, put likes in the comments. Let us know what city you are in listening to this information. I am in Chicago. I am licensed in 19 states. So we do offer mortgage lending in several states. And we're just here to bring you this information. We want to talk about the good, the bad, and the ugly, right? So we're going to go ahead and get started. DU credit gate removed, right? What that means is that now the credit score requirement, according to Fannie Mae, and keep in mind, these guidelines haven't become effective for us yet. This is just the information that I have so far. What is happening now is that you no longer have to have the minimum credit score requirement. The minimum credit score requirement for FHA is not 580 like some people think. It can go down to 540, 500. So there are minimum credit score requirements for different products, different services, and different down payment. For conventional, right? Conventional loans, the credit score limit was a 620. Today, the credit score limit is going to be removed. That is great for many people, right? Because you have situations where individuals were scoring, meaning we were getting an approved eligible with the 600 and with the lower credit score because they had very strong other components in their file. When you're dealing with a conventional loan product, you are dealing with a lot of different factors. Unlike FHA, conventional is looking at your credit score. They're looking at your reserves. What are reserves? Reserves are the amount of money that you have in your bank account, right? So if your mortgage payment is $3,000 and you have $100,000, then they're going to take that number and then you're going to have about 99 months of reserves in there, right? So that way you have money in case of an emergency. So if you only have 1 or 2 months, you're going to be considered a little more risky. Whereas if you have 6 months, 12 months, 24 months, that makes the file stronger. And for all of my clients that used to come to me and say, I just inherited $3 million. I want to purchase this home. I want to go conventional. They did not have the credit score. However, they had millions of dollars in the bank. They would be a person who would be fully benefited in this change, right? And we're going to go through all of it. But that 620 gateway is now removed or going to be removed. So you don't have to have that minimum credit score. That is what everybody's talking about. So I keep seeing everybody post, oh my God, this is a game changer. Oh my God, this is amazing. And I don't think people understand how much money it costs to go conventional and have bad credit. And I don't want to offend anyone tonight, but because I was somebody who had a credit score of 760, I've had a credit score of 580 before, right? And 680, 700 used to be a very good credit score. I was just doing a loan for my family member today, and I ran his credit scenario at 720, right? Your credit score matters. I changed his credit score in the system just for, I don't want to curse, but just for, I was going to say, but I would just change his credit score just to kind of see what was out there. And from 720 to 740, his interest rate changed from 6.9 at 720, which is supposed to be excellent credit, right? At 740, his credit score changed to 6.4. Now, this was for a 4-unit property. In addition to that, the monthly mortgage insurance, that is what you pay on a conventional loan based off your credit score if you don't put 20% down. I will say that again. If you are in an FHA loan and you purchase a home, your monthly mortgage insurance factor is 0.55. Whether you got a 540 credit score, a 580 credit score, a 620, a 800, or whatever score you have, that is your mortgage insurance factor. Well, I just let you know that based off going from a 720 credit score to a 740 credit score, how much your interest rate changes. Well, in addition to that, your mortgage insurance changes. So in this same exact scenario, from going from 720 to 740, and mind you, this was a purchase of $708,000, the mortgage insurance on the property, just for those 20 points, changed from $691 to $341. So now, because this client basically has a 740 versus a 720, he gets a 0.5% better interest rate, and he gets almost half the mortgage insurance because he had the better credit. So mind you, and we're going to talk about that again, how we go from 740 to 720, and then we go from 720 to 680, and then 680 to 660, 640, 620, and then we're going to drop from there. And I'm going to show you that in one of these slides. I saw a question come through. Emeka, did you want to repeat that question for me really fast? So you never know. That is a really good question. Normally, this is not like a down payment assistance program. Pretty much when they make changes to a policy, they make it until it becomes a problem. So, and I'm going to give you an example. We used to be able to take rent. So if you were going to rent your house out and go buy another house, we used to just be able to take whatever lease you gave us, right? This year, they changed the guideline where we need a lease and we need a market comparable. So if you rent your house out for $4,000, but the market rent is $2,500, we're only going to use $2,500 for our file. Now, this is not a real rule, but I personally think that the reason for that is because they've had problems. And when they identify a problem, they change the guidelines. So they can change guidelines at any time, but normally you get your guideline changes between November and January for the following year. The last couple of years, the guidelines have been bouncing all around. Like when I say bouncing all around, it has been crazy. This year, we had some new guideline changes. Actually, last week, we had another one where Freddie, which is, we have two conventional engines. We have Fannie Mae and we have Freddie Mac. Freddie just changed their policy. Now they're letting you put 5% down. Fannie has been doing that, right? But the glory of it is that Freddie allows an ADU. Fannie does not. So the guidelines are tricky. And to answer your question, we don't know when they're changing. So you just always want to work with a knowledgeable loan officer that is up to date. When we get those guideline changes, we read them, we teach them to our team, and we make sure that we are switching with the changes because they are changing like hotcakes these past 4 years.
What is the ADU?
Good question. So an ADU is an accessory dwelling unit. So say, for instance, you are purchasing a 3-unit property and you have a coach house or you have an illegal basement. Before, lenders wouldn't lend on such thing, and then they would not give you rental income for it. Now that the city of Chicago, especially Cook County, has changed their stance on ADUs, accessory dwelling units, we're now allowing you to use one. So on FHA, if you have a coach house, an illegal coach house, and a 3-unit property, we will allow you to use that coach house, and we will allow you to use the rent from that property to qualify, okay? If you are purchasing a conventional property, same thing. Say, for instance, you have an illegal basement and an illegal coach house. Now you kind of have a problem, right? So now you might want to go with a renovation loan and make one of those units legal. I will tell you that in your count, the total units cannot exceed 4. So if you have a 4 unit and you have an illegal coach house or an illegal basement, that doesn't work because your total units is 5. But if I'm your loan officer and you have that 5 unit, you can always go to a 203K and disable that kitchen and bring it back to a 4 unit. But we'll leave that for another zone. We'll leave that for another zone, guys. The ADU, so ADU has a bathroom and a kitchen, and that's what makes it an ADU. Because people don't know this, but if you have a finished space, like say for instance, you got a gorgeous coach house, right? If you have a finished space and no stove, so you can have a bar, a refrigerator. If you have no stove, and for all of my people out there that's trying to figure out how to house hack the wrong way, not a space for a stove and a gas line where you can just add it back later. But if you truly just have an entertainment space, like I wish you guys can see right now in my office, I built like a little mini bar, and it has a sink, it has an ice maker, it has a wine cooler, but it doesn't have a stove. So it is not considered a legal kitchen or whatever the situation is. But as long as you don't have a stove in your, cosmetic kitchen area, then it's not considered a legal unit. It has to have that stove in there. If not, it'll just be considered finished space. Emeka, I missed that last question, I think. Let me see if I can pull these questions up, guys. We got 2 people in the waiting room. Can we grab those?
So the question, Natasha, is a convection oven considered a stove? Now,
No.
some convection is not.
Okay. I don't think so.
Because some convection ovens are the size of a stove.
Well, that would be different. If it's on your countertop, I would say no. Are you asking because you want them to consider it an ADU? Or are you asking because you want them?
It's just a question going forward.
No, good question. I just wanted to make sure that I answered it in the right angle.
Okay.
So yeah, if you have so convection oven, so if you have a convection oven that cooks like a stove and looks like a stove, then that might be considered. But if you want to send me a picture of it, I can run it through our appraisal department, and then we can have that answer for you already ready. So that way you'll know your answer before you start whatever transaction you're considering.
Well, so I can just say this, because some convection ovens, like KitchenAid they look like gas stoves. They can be a combination of gas stove and convection, which I recently purchased, or it can just be a convection oven that look like it has gas, but it's just convection.
Well, when the appraiser comes out, he'll assess that, but I've never had that question, which is great. So I'm eager to know now.
Yeah, because a lot of these stoves are, with the convection, they work just like gas. I mean, they cook just like gas. I've been using my convection more than I use my gas, even though it's a combination, but I go for the convection function better more than I do the gas. So
I guess the answer to your question is going to be, what does the city of Chicago allow? So if the city of Chicago will allow you to complete a unit and get a permit with that convection oven, then that would make it a legal unit. But if the city of Chicago does not allow that and utilize a convection oven, because we're going to basically be following the code and the compliance of the city and the municipality of where the property is. So if the city does not allow your convection oven to be considered a legal stove, then we would just call it the way the city calls it. Yep. And then, so DU is still analyzing your credit report. So we're going to go back to the whole Fannie Mae thing. So what this policy is not, right? This is not like a new credit policy where you don't have to have any credit score. Some people may have a 600 credit score for the weirdest things. Like I have a client right now who has a 721. We ran the credit today. The credit only went up 1 point. They paid off all their credit cards, everything. I'm talking about perfect portfolio. We really need a 740 and we have a 721. So we don't know why the credit hasn't updated to the 740 as what it should, but that can happen to anybody. So there can be someone who got a late on their credit, or they were dealing with something, someone fraudulently used their data and they really have to buy this house and it must be conventional. So that that would be the person that is great for this new policy, right? It's not an LLPA waiver. An LLPA is what is utilized on the deals to make you have to pay, you know, they're called loan level pricing adjustments. And we do loan level pricing adjustments based off your credit score. So like I gave in my first example, if someone had a 720 versus a 740, their mortgage insurance was $300 difference because of the LLPAs, meaning it's a 4 unit, so I'm going to hit you. I'm going to hit you for your credit score. I'm going to hit you if it's a condo or whatever the situation, if you're taking cash out, right? So all of those are reasons that are going to affect you. And I honestly believe like all of this stuff that's going on right now is to make somebody rich, because mortgage insurance companies and monthly mortgage insurance companies, they are about to make a lot of money off of this new credit score change. It is literally about to be insanity. And with the new, and that'll be a whole nother Zoom, with the new announcement about going to a 50-year mortgage, if you combine a 50-year mortgage with a 600 credit score, conventional, you probably going to be paying an extra $700,000 a year. I mean, and over 50 years for this said house, which is basically money that could be in your retirement. It's not MI free. We just discussed that. And it's not a change for conventional loans, right? The FHA, VA, and USDA are still, we still have existing credit scores and minimums for those programs. This program is just simply for conventional loans. The good expanded access and opportunity. So this is going to help us reach, the borrowers have a broader reach, right? You're going to have expanded access to be able to get into a conventional loan. Why is everybody so excited about conventional versus FHA? Because the loan limits are higher, right? If I wanted to buy a building today, and we keep like I said, the guidelines keep changing, so don't quote me exactly, but a 4-unit FHA is probably about 800 to 900,000 on loan limits, right? On a conventional loan limit, it's 1.5 million, right? So you're talking about having 500,000 more buying power, because now if you didn't have a 620, you were stuck in FHA. So a lot of people do want to go conventional. Like if you're buying a condo, it's hard to get some condos FHA and VA approved. So a lot of the investors, they only want conventional. So yes, this is going to open up a lot of great avenues, but we definitely have to tread lightly and make sure we are evaluating our risk. Because what I don't want to do is normalize having bad credit, right? So all of these programs are coming out to say, oh, it's okay that I didn't pay my bill on time or I didn't open that mail. We want to normalize having a great credit score. And if we are in a unique situation where something happens to us, we have these guidelines to help push us through, and we can refinance and live to see another day. And I love to give examples, and I want to give an example of to myself. I actually signed up with a alarm system. I'm not going to quote the name of the company, but I was getting ready to buy a home. It was a very big deal to me. It was an investment property. I know that I had to have a 720 credit score. I had been holding that credit score for a little while, keeping my credit cards at where they needed to be because my credit score kept fluctuating. Well, guess what? From an alarm from 4 years ago that I had already resolved with this company, they decided to mark my credit 100 and something day late, right in the middle of my purchase. My credit score dropped from a 740 down to like a 679. So now, what if I was in a situation where I was buying a house and my credit score dropped from 700 to 600? This is when this program is a great program, because now I can do a Band-Aid, get into my property so I don't lose it, but then I can refinance out, but not make that be my long-term solution. So I had to fix my credit, do a rapid rescore, and get my credit score up. But I would have never knew that happened to me had I not pulled my credit to purchase this mortgage, because I wasn't watching my updates from Experian, which was going to my alternate email. But what I'm saying is things happen to people where they need scenarios, and this is a good thing, right? But you have to tread lightly because it can cost you a lot of money, okay? Smarter risk assessment, there are going to be fewer rejections at 619. Right now, DU is going to weigh compensating factors. What is a compensating factor? Like we talked about, I have extra money in my savings. I have low DTI. What is DTI? It is debt to income ratio. So if I make $1,000 a month, and with my mortgage and my minimum credit card debt is $700, my debt to income ratio is 70%. Where do they want your debt to income ratio to be? On conventional, the max is 50%. So 50 is the max. So we talked about LLPAs. If you are at your max, you are going to have a much higher mortgage insurance factor and interest rate. But say, for instance, you make $1,000 a month, and with your new mortgage and all your bills, it's only $100. Now you're at 10%. So even though you may only have a 580 credit score, 10% debt to income ratio, 24 months reserves in the bank, you're still strong over here, even though you were lower on your credit score. So it's now going to blend your situation together and help score you. So you'll most likely get approved, but with that higher interest rate and that higher credit score. So congratulations, we can get you into that property, which is why we should be excited. But also congratulations, let's put you on a plan so that way we can fix that credit so you don't have to pay triple just for that credit forever. And let's talk about FHA, because a lot of people think FHA loans are bad loans. I can get the same value FHA conventional, and I can close you in 2.5 to 3 weeks on an FHA loan, just like I can on a conventional loan. Why? Because we're pre-underwriting these loans before they go to processing, right? And we're making sure that we have good closable loans that can close on time. If people have problems and they need steps, we try to get them to take care of those steps before they get that pre-approval, so that way they can move quickly, especially in this market, okay? And I'm going to, oh, so now they removed the credit score. So what we're talking about tonight is that Fannie Mae has now removed the credit score, where you no longer have to have a minimum credit score on conventional. So there is going to be no score. Today, the score is 620 minimum. Now you're going to be able to, with a 580, if you get approved through the automated system, you'll be able to get an approved eligible on, you'll be able to get approved for a conventional loan, even if you have a lower credit score under 620 now. That has what's changed on the market. What they're not telling you is that you're going to have slightly higher interest rates, you're going to have slightly higher mortgage insurance, but you are going to be able to purchase that home. And now we are going to be able to use other things other than your credit score to help you get pre-approved or approved through the automated system, which means you'll have extra income. You may have a lower debt to income ratio. But if you are a client and you have a credit score lower than 620, you have a 50% debt to income ratio, and you have no reserves, I doubt very seriously if that's going to get approved through the system, because it's been hard to get those approved through the system now, even with that 620 score. We have programs called Home Ready. Through Fannie, it's called Home Ready, and it's a program for people that have slight lower credit scores. So once they roll all of this out, we'll be able to see if Home Ready will approve these scenarios with the high DTI, the lower than 620 credit score, and the higher debt to income ratio. We'll be able to see if it'll approve it. But right now, we just have information. We are not privy to run these files through our systems yet to see how it's going to affect a client. But that Home Ready will be a game changer. Now, if the Home Ready comes back with super discounted mortgage insurance, allows you to have lower interest rates, and accepts the lower than 620 credit score, then it could be a little exciting. But based off what we see now with the 620, Home Ready hasn't been even approving the 620s as they should. So I'm just imagining with the lower credit score, it's going to be a little harder for people to get approved. Any more questions, Emeka? And thank you for assisting. Mm-hmm. Yeah, we still have 97%, 3% down conventional. We still have that. And we even have some programs where you can get, a 2%, sometimes we have it where you could do 1% down with a 2% grant. But yes, we still have those programs, but the minimum credit score on that program was 620. And now that minimum credit score is going away. Which gives us a good question. I mean, our next topic is, the market confusion and the operational reality, right? Right now, we're seeing all the Facebook headlines saying, oh my God, credit scores are no longer needed for conventional loan. Yay, the market is going to go crazy. We're about to clean up and we're about to be super excited. No, we're about to spend a lot of money on interest rates and mortgage insurance. So what we want to do is make sure that we understand the difference between an FHA and a conventional loan. And I will tell you that if the property can go FHA and you don't have at least a 660 credit score, you really want to have a 780. I'm just being honest. But if you don't have a 660 credit score, at least you want to go FHA. So unless there is a loan limit reason, unless there is the fact that you're purchasing a condo, a flipping rule, FHA has a thing where if the seller has not owned the property for 91 days, they can't go under contract until 91 days. So there are reasons where conventional is a requirement. But to all my listing agents, I love my listing agents that are allergic to FHA loans for whatever experience you had with whatever lender. I am here to tell you, give Natasha's team a chance because we can get those deals closed. And if you are worried about value, when you list your property, just make sure that you have comps. And when the appraiser comes out to the property, right, make sure you give them your comps because you're the one that is meeting the appraiser. Like you can give the information that you have over to them. The lender, as lenders, we cannot talk to the appraisers. Now, one more thing why people don't like FHA loans, and it's valid, is for my 3 and 4 units. On 3 and 4 units, we have to meet what's called self-sufficiency. With the prices right now and the rents, and I'm going to say this to my listing agents again, can we stop listing the multi-units for the most expensive amount and not changing the rents? I don't know how many $800,000 4 units I can see with $800 and $900 in rents. Like, we need the prices to match the income from the properties. So I see this all the time. And I know the sellers, they have long-term situations with their tenants and they don't want to increase their rent, but they want to sell the property to the new client at the highest price, but still have the lowest rent. So it doesn't balance. So once again, we could do one-on-ones. I don't want to confuse you because there are so many guidelines. I could just feel my brain spinning already, but there are so many guidelines. And guys, while you guys are listening today, if you have any topics that you would like us to come back on and do a webinar on different topics, whether it be FHA, whether it be multi-units, house hacking, self-sufficiency, we can bring you those Zooms. Just let us know what you want to hear. Drop that in the chat, what you want us to hear us talk about, and we'll definitely bring other Zooms back to you guys that may help. The ugly, right? Practical pitfalls to navigate. We've been talking about this all night. Borrowers with scores near or below 620 may still encounter significant higher interest rates and fees. We didn't talked about that all night, right? Documentation burden increases. They're going to want to know your DNA, your brother's DNA. I'm talking about they are going to underwrite these files on a whole nother level, in my opinion, right? So get ready to get an extensive documentation request. You know, you may need some non-traditional credit. We are going to be crossing our T's and dotting our I's because what we don't want to do is deal with a default. We do not want to give a borrower home that cannot afford it. And if you don't have at least a 660 credit score, you have already shown that there are some gaps there as it relates to paying things on time and just the value of maintaining that high credit score. So you are going to have a little bit of additional documentation that you may not have with the higher credit scores because you have repurchase risk exposure, right? So we have to sell these loans. So what happens when you work with a lender, even if you work with a bank, you know, like I don't even want to say names on the Zooms because I don't know what's legal or not, but if you work with your local bank, if you notice, if you look at your credit, you'll see bank this and bank that. It'll be the name and then it'll be a few different letters behind it. It's because banks have mortgage people, they have servicing departments, they're all different type of things. But sometimes banks will sell that loan within their own bank. So I'm saying this to say that people don't want to do mortgages. Banks don't want to do mortgages and get stuck with them. So they have to make sure that they underwrite that file in the best of their ability so they don't end up having to keep it on their books. Any questions, Emeka? Because I want to go over this LLPA screen so they can see what I'm talking about. All righty. So go ahead. Good question. So FHA is and conventional loans are different engines of the government. So they're insured differently as well. So you have your FHA loans, you have your conventional loans, which we're talking Fannie Freddie tonight, and you actually have VA loans as well. An FHA loan is insured by the government. So basically with an FHA loan, if you were to default, say for instance, you bought your house for $300,000 and you didn't pay your mortgage and you foreclosed, right? The bank is insured where the government will help bridge that gap so they don't lose all of their money, right? Conventional is not insured in the same way, which is why conventional loans have mortgage insurance companies that help them bridge the gap because they have the 80%, right? Like if you put 20% down, you don't need mortgage insurance. The mortgage insurance on the conventional loan helps bridge the gap. So say for instance, you foreclose on your house for $200,000. 20% of $200,000 is $40,000, right? If it costs the bank $40,000 to put your house on the market, get you out of it and sell it, they still have the ability to push if they get that money from the mortgage insurance company and they're only left with that 80%, right? And I know that was a lot of information. So the difference between the two is how they are insured. They both have totally separate guidelines. Your FHA loan has totally different guidelines from your Freddie conventional and your Fannie conventional. Different guidelines because Freddie is not taking a less than 620 credit score right now. Only Fannie. So this is your conventional bucket. FHA, 3.5% down, 1 unit, 3.5% down, 2 unit, 3 unit, 4 unit, boom, still going to be 3.5% down no matter what. If your credit score is a 580 or a 800, your monthly mortgage insurance factor, 0.55%. That's amazing. On conventional, if your credit score is 720, your mortgage insurance factor might be 0.87. I think it was 1.13%. Whereas if you had a 740 credit score, it went down to 0.67 mortgage insurance factor, right? That was a difference in $300 payment for my relative. The other thing with FHA is they just have different guidelines. They have different loan limits. So it's like you're dealing with 3 different scenarios in the same world. So as your licensed loan officer, what I do is I help you or your clients get pre-approved. And if you qualify for both, we go over that scenario. I had a scenario with a realtor and the client should have been in a conventional loan, right? The thing with this particular client is that on a conventional loan, the closing cost credits that are allowed from the seller to pay, they're different. Conventional is 3%, right? Max. FHA is 6%, right? You see how we're playing the guidelines against each other. Well, this particular realtor negotiated the seller to pay 6% on a conventional pre-approval. Well, my pre-approval specifically said conventional loan, max 3% closing costs, and she didn't read the pre-approval. She didn't want to negotiate it, so she wanted to encourage her client to go conventional, to go FHA, because she didn't want to negotiate the contract. So after getting on the phone with her and her client, I explained everything. I thought it was very clear. The client wanted to go FHA. Now, I'm not a salesperson. Even though I do loans every day, I'm doing a webinar. I'm not a salesperson. I'm not going to like twist your arm or twist your leg. I'm just going to let you know what goods I have. And they're normally going to be what you want. And then I'm going to get you to the closing table. So I'm able to sell what I have because we have good products. So the client was able to think about it with his wife. And he called me back and he said, now I understand what you were saying. Going conventional didn't make sense for him because he was able to put 3% down. FHA was 3.5. Mortgage insurance factor was 0.2 instead of 0.55. And I'm going to tell you one other thing about FHA. Every single FHA loan, you got to pay 1.75% mortgage insurance. So he would have had that extra 1.75% tacked onto his loan for 30 years. So in his situation, with his 720 credit score, conventional was the better route to go, which is why I'm saying as a loan officer with the products, we'll always let you know kind of what's best for you. And team, I see you guys. I know you guys are on because this is something I want to be able to do with my clients live that I don't know how to do yet. So you guys have to bear with me. But if you look at this grid, and it's a little small, but this is what is called our LLPA factors, right? So as you can see, if the debt to income, if the LTV is 30%, it's no hits. If it's 60%, it doesn't get any hits until you get, this is 639. This is a 639 credit score, okay? We don't even have 620 on this grid right now. And we're talking about going under 620, right? So if you're at 70%, you see that 1.25% hits at 639, right? You go to 1.5%, okay? Now, say for instance, you were putting 30% down or had 30% equity. Now we start looking at these other LLPAs. These are adjustments, right? So if you were to have 30% down and you were looking at an investment property, now I'm going to also what we call hit your interest rate, right? 1.625. So these are the factors that make your interest rate higher, because I got to hit you for 1.65 here. And then if your credit score is under 639, 1.5, that's 3.1%. But this is with 30% down. Who's putting 30% down? No one. So let's go to the area where our clients are, right? My clients are ranging between 25% and 3%. It depends. Believe it or not, I've been getting a lot of 20% downs lately. I guess they've been growing money trees, but my clients have been doing really good in the market and saving their funds, and they have, they've been getting really good jobs. I've been so excited to see the change in everything, just the clients in the different communities. I just love seeing the wins. But we're going to just talk about this situation. That give that heart, Vanessa. Yes, I'm excited. Y'all started doing loan amounts of 50,000, and now my clients buying $1 million homes, and it's just been amazing, y'all. We have financial advisors that we're talking to. We putting money in our 401k. Like, we are really taking this wealth thing serious around these parts. So 2.65 is the hit if you're putting 10% down. Okay, but look at this, guys. Investment property 4.1, second home 4.1, right? Just say for instance, it's a condo, 0.75%. So if you have a 639 or less score, put 10% down, you already negative 3%, right? On the back, this is not interest rate, but you already have 3% in adjustments before you even look at today's interest rates. Now let's go to the real reality check, okay? Because now let's go to our 5%, our less than 5% down. So because it's a premium program, like if a client qualifies for the 3% down, they're generally getting incentives. So as you can see, 5% down with a score under 639 is 2.25% hit, okay? 2.25% hit. But if you have a high balance, or if you do a condo, then we just add things from there. And that was a lot of information, right? That was a lot of information. But what I want you to know is that loan level pricing adjustments is what you get when you don't have good credit. So when you start dropping down on this grid with this credit score, it gets ugly, right? So I just want to let's motivate our clients to have good credit, because if they get into a hardship, if they lose their job, they can go to Home Depot, they can go to anywhere that they need to go, and they can get credit so they can live to see another day. We work hard every day, right? We live check to check. We can't quit our job because we got to take that time to be able to position ourselves to have good credit, to have additional money, so we can choose where we want to work. We can choose where we want to live, and we can choose what we want to do. And I don't want to start preaching, guys, because if anyone knows me, they know I get into the preaching. So I'll carry on. We talked about FHA versus conventional. So whoever asked this question, this slide is for you, right? FHA typically wants a 620 credit score. We can go to 580, but we do encourage you to have the 620. The higher your credit score, the more you qualify, right? We talked about the upfront mortgage insurance fee of 1.75. We also talked about the monthly mortgage insurance 0.55%. That's for the life of the loan. I didn't tell you that on conventional, it goes away after 10 years, or you gain 20% equity. So that's another benefit from conventional. So we're not knocking conventional. I love conventional. I prefer conventional, just not with a 620 credit score. It gets a little more difficult unless you have, like I said, a Band-Aid situation where we're going to get you up out of that situation, right? Conventional loans, we have the rate and MI are basically based off of the credit score. So having a 620 credit score can cost you money in the conventional world. However, it's available for you. Just use it wisely, okay? Or it's going to be available for you. With high LTV, like I said, the mortgage insurance can cancel at 20%, And you have much more buying power in the conventional world as it relates to condos and as it relates to your loan limits and as it relates to these FHA, not FHA, but as these multi-unit properties that you're getting a deal or not a deal. But if you're buying a 4-unit, because they're hard to find, right? You're buying a 4-unit and the rents are just low. In a conventional world, you will be able to purchase that property and hopefully you get a deal because the rents are low. And then you can take some time and go into that situation. And then you can take those tenants and get new tenants and get those rates up. So you have time to grow with the property. Whereas on FHA, we're going to need either you're going to qualify right now or your market rents have to at least be at a certain amount in order for that property to be approved, because you have to get pre-approved on the 3 to 4 unit, but the property has to pass what we call self-sufficiency in order for us to lend on it as well. This is an illustrative payment comparison. Please note that this is not a scenario. This is just used for illustration. So this is not what our current interest rates are or any scenario or to be used in any type of way. I just want to make sure that I quote that. But if you were to put 3.5% down and you had a base loan amount of $337,750 FHA, right? You're going to be financing $343,660. I'm sorry, you're going to be financing $343,660. This is for a $350,000 purchase. If the rate was 6.5, and just so you guys know, I have seen some rates with 5s on them this year. FHA, this end of the year has been quite amazing. The monthly payment with principal interest on this FHA loan with a 620 credit score would have been $2,237. Whereas if you purchase this same scenario, put 3% down on a conventional loan, rate in this scenario went from 6.5 to 7.125. Mortgage insurance factor went from 0.55 to 1.20. Okay. MI, mortgage insurance, went from $155 a month. FHA, conventional $340. Now, if you had a 720 credit score, your mortgage insurance probably would have been $90 in this situation, right? That's the difference, 90 versus 340. Oh my God, do we really want to get a conventional loan with a lower than 620 credit score? No, we want to get our credit score up. That's what we want to do, right? So in this particular situation, we are seeing almost a $500 difference, $400 and something difference just from going FHA 350 versus, versus conventional, versus conventional 620. I am not giving you illustrations lower than 620. Okay. I am giving you illustrations at 620. Under 620 would be worse. Any questions on that payment comparison? Y'all see why I had to bring y'all this Zoom tonight? We had to bring this Zoom tonight. Y'all see this payment? Let's just. Come on, y'all. Let's go. So debt to income ratio is your income versus your debt. So in the last slide I gave you, if you make $1,000 a month, right? And your new mortgage and your minimum debt for your credit card, student loans is $500. Your debt to income ratio is 50%. If you make $1,000 and your debt is $100, your debt to income ratio is 10%. FHA will let you go back in 56%. And when I say back in, they're going to look at your debt versus your mortgage, which is your front end ratio, and your debt versus your mortgage and all your other debt. So FHA will allow you to go to 46.99 over 56.99 in most scenarios, from my experience, where the credit score is 640 or better. When the credit score gets lower, FHA starts changing where it won't approve it unless it's 45, the debt to income ratio, or got to go to 36%. So we are using automated underwriting, which is giving us the scoring of the system. So we put it in the system, but then we have to trust but verify through the government's automated underwriting system, which we call DU, desktop underwriting, okay? We do have situations where we can go manual, meaning we're not going to run it through the desktop, but we have to meet maybe a little more underwriting guidelines in order to get that processed. Okay. Whereas, yep. So I'm sorry, I lost my train of thought there, but yes. So that's pretty much the difference between that, that debt to income ratio So you want to know what is your debt versus how much money you make. Now, for my veterans, you guys don't really have a debt to income ratio. On our grid, guaranteed rate cuts it off at 65%. So you can actually go to 65% to my veterans, right? But you do have to be a veteran in order to do that. So that is a perk that VA allows for their veterans. Any more questions on debt to income ratio? What was it, SB? I got to see what is the SBL loan. You might be teaching me something tonight. Let me see. Let me see what that is. Can you expand on
It's
what
a
the
small
SBL
balance loan.
Oh, small balance loan. Thank
Yes.
you. My minimum loan amount is pretty much 150, and it's not that I only do loans for 150. It's just that because I'm a broker, we have what's called high cost, and it has to get approved through our system called Mavent. So if you have, are you speaking like a 40,000 or 50,000 loan
No,
amount?
these start at 1 million. So these are for business, for commercial.
So no, we don't offer those, but I have lenders who do offer those.
Okay.
So I can refer you to someone actually, and he's really good. And his minimum is the lowest loan amount he'll do is 1 million.
All righty. Thank you.
And thank you for sharing that. Upfront mortgage insurance. So upfront mortgage insurance is a fee that I get 0% of. It goes directly to the government. And what it does is go in a pot for people who foreclose. So, and that's just my explanation. Okay. So I just want to repeat, that's my explanation. But FHA loans are very risky loans because they're taking the lowest credit score, the highest debt to income ratio. You only have to be on your job for 6 months, guys. Like if you were off work for 4 years and you went back to work, you only have to be on your job for 6 months. As long as you have 40 hours or salary and you work 2 years in your life, you can just go back to work 6 months and buy a house after being off work for 20 years, as long as you work 2 years of your life, right? So with that being said, FHA is the most riskiest. So they collect upfront mortgage insurance, UFMIP. And when I first started in this business, I think upfront mortgage insurance was factored at like 0.85. Can y'all believe that? And I'm not going to tell y'all how long I've been doing this, but 0.85 was the factor. So now if you buy a house for $500,000, that's almost $9,000 that's going into the FHA pot. So every time they close loans, they collect this fee and everybody's paying it, right? So you buy a $1.5 million deal, you're going to pay your upfront mortgage insurance. And that is the insurance for FHA. And I think that that's how they use the funds to fund defaults, because they're going to have way more defaults on the FHA side than the conventional. But now that Fannie has dropped this 620, we're going to see how that changes the numbers. Any other questions?
No, one more question. Okay, so just correct me, please. So the lowest loan amount that guarantee rate will consider is $150,000. Is that correct?
So for FHA, conventional could probably go about 100,000. It depends on, to answer your question, it depends on the fees. The title companies are charging so much in fees now that total closing costs can't exceed 5%. If you go to a bank,
I'm sorry. So if it was, I'm sorry. So the $150,000 would be the asking property selling price. That's always the starting factor, and that's my question. So when one is looking for a mortgage loan, they will go with that selling price. So my question is $150,000 the minimum amount that guarantee rate will consider?
No, the answer to that question is no. It depends on your loan officer. It depends on your program, and it depends on your scenario. I've done loans for 80,000. It just depends on the scenario. Based on what we've been seeing, that's kind of been the golden number, but every scenario is different, right? So we can have a situation where the seller is paying the closing costs. So we can adjust fees. So it's going to be determined case by case scenario. I just use the term 150,000 for me. So that way, if I can refer a client to a bank that doesn't have the restrictions that I have, then it's just kind of easier for them, right? So I refer them out because sometimes we can do it and sometimes we can't. And I don't like to put people through paperwork process, but we can look at them one scenario at a time. But from what I've been seeing, go ahead.
So at what point, just looking at the selling price, do I even consider making a referral?
You said
What's
at
the
what purchase
lowest?
price? Is
So,
it
yeah, what's
is
the
it still
lowest?
property? What city are you in?
Chicago.
You in Chicago? So we have properties under 150. I mean, under 150 purchase
Absolutely.
price.
Well,
I haven't
those
seen.
be
What is
condos.
that?
Those
Oh,
be
condos.
condos.
So conventional is different, right? So FHA is 150, renovation is 150. Conventional is a little different. It's not as tough. It's just going to depend on where these title fees are coming in. A lender
And
cannot
that
charge.
but you can get a conventional for a condo, correct?
You want to get a conventional for a condo because
Oh,
all
absolutely.
condos are not
Okay,
FHA approved.
I was just wondering, when you're doing a negotiation, because you just kind of open up that Pandora box. You open up that box.
And
I'm
it's a
just curious.
discussion. No,
Okay, and that's okay. Okay, thank you for that.
I'm just saying
So then,
your questions are good.
thank you. So say the asking price was 150. Okay, and most of my clients are already pre-qualified. I don't work with them unless they are.
As you
So they
should.
they were okay. So the condo is at 150, but they're qualified for 170. So how does that work?
So if they qualify for 150 and 170, they'll be fine. If you have
Okay.
clients that are coming in, 80,000, 100,000,
And
then we have to look at the title fees and we have to look at it as a case by case scenario.
so
Right.
it's not the property, it's their pre-approval is what we're
Right.
speaking
It's the
of.
title company and the fees. Because some of the title companies, you could buy a property for 50,000, but the closing fee might be $2,000. Right.
Right. And I
So
get that. So
Illinois has what's called a high cost rule where a borrower can only pay a certain percentage of the purchase price and fees, right? They have a
I get
max
that.
on how much.
Illinois is very unique in a lot of ways. And it's just outside of the rest of the United States, in my opinion. But with my question being answered is this: if you have a buyer who is pre-approved, let's just say at 150, so you'll work with a
Then they'll
buyer
be
that's
fine.
yeah, yeah. So it's not the property price. It's the pre-approval of the client.
It's going to pretty much determine the fees. And what we do with the client is we recommend some ways to get that done. So if they qualify for an FHA loan, they can get up to 6% in credits from the seller. And the seller's fees can assist because the fees that the seller pays doesn't count against the client. And conventional, the max is 3%. But if they put 10% down, and I don't have this guideline in front of me, they can also get a 5 to 6% seller credit with the conventional more money down. So we can offset some fees by having the contract negotiated with the seller paying closing costs to assist with that.
Okay, so I'm not going to hijack the conversation, but one more thing. I'm just going to go back to, because one of my things that I bring to my consultation is that my clients are pre-approved. So looking at that pre-approval, you're looking more at the client without a property. You follow me? So we don't have a title. We don't have all of that. We
We
just
use
have the
estimated title
person.
fees. We use estimated title fees. So if I can't get them to score through the system, then I won't issue the pre-approval, or I'll say you have to make sure that we stay in this range, so that way everybody's on the same page. But we do our pre-approval based off of live numbers. And then it's just up to the agents to stay in those numbers. And if you go outside of the numbers, then we want to run the scenarios separately.
And that's with the property. Yeah, that's once they find something outside. And I thank you. I appreciate you. Thank you.
No worries. And thanks for joining us tonight. Who might benefit under the new DU guidelines, right? Borrowers with a lower credit score range, solid income, healthy reserves, and lower loan to value. So we've been kind of saying that all night, and those borrowers are going to win in this scenario, okay? Applicants with limited credit history, but positive alternative credit sources and stable, verifiable payment histories, right? Those clients are going to benefit. First-time home buyers, right, who qualify for AMI-based waivers and things like that, like Home Ready, potentially reducing overall loan costs significantly. So we have all different benefits under these new guidelines for clients. So there are some benefits. We just want to make sure you know the facts. So we're not here to say that it's not a great thing, because it is a great thing that we are going to be more flexible and we're going to allow more people to qualify to purchase homes on the conventional level. But there are going to be some financial penalties for those that don't have sufficient scores, just like there are penalties now for clients who don't have a 680 or a 720 and they're coming in with a 640 or 660. They're still being penalized based off their score. It's just going to be a harder hit, we're thinking, for the people that are under the 620. What others are saying, right? Many influencers that we see on social media, this is a game changer. And maybe it is, right? Maybe it's going to change the game for people that are in a situation where they're in a Band-Aid situation. They want to get this house. It gives them the opportunity to get in and come up with a strategy to get things lower in the future, a temporary mortgage situation, so that way they can come out and save money in the future, right? Core underwriting standards and pricing, they still apply. So that's the caveat. We're going to have to pay for having the lower credit score, and we're going to have higher interest rates and higher monthly mortgage insurance. Okay. So our key takeaway is it's not easier money. It's smarter gating. You want to pay attention to what is happening. You want to pay attention to how much things are costing. And if you're in a Band-Aid situation, get out of it, but know your facts. If someone is putting you or your client in a conventional loan and you have a credit score under 720, ask them to see the both options, because you may see a $400 to $500 monthly savings like you did on the last slide, a couple of slides ago that we showed you that illustration, okay? Action items for buyers, right? They want to get a full pre-approval, not just a soft pull. Clients call me every day. Do you have to pull my credit? I don't want my credit pre-pulled. Credit is meant to be pulled, right? Because you're purchasing a property, and credit is good for 120 days. You don't want to find the home of your dream and then get your credit pulled, and now something's happened and your score is dropping. You have to work backwards and you don't qualify anymore. So at least get your pre-approval, your credit ran one time with the lender. I do soft pulls for all my clients first, but I don't issue pre-approvals with soft pulls unless you're very strong files and there is nothing that really can influence you. But if you're a borderline and if anything happens, you don't qualify anymore, I'm going to have you have a hard pull. Why? Because closing deals on time is free marketing. And I want to have the reputation that when you get a Natasha Robinson pre-approval, and I've been doing this for years, to know that we are going to close. And if something comes up that I didn't know about it, that's going to stop you from closing, I want to let you know immediately so you do not waste your time in a situation with a client. So it is my job to give excellent pre-approvals. So that way you can win the bid. The sellers are confident. I am 100% out here with a lot of sellers that personally know me. And I didn't even know that they were looking for my name on pre-approvals to determine what offer they were going to accept. So we do that by not allowing clients to come in with no credit pull, go under contract, then the deal is dying, and we got to start underwriting them. We do not do that on the Natasha team. I apologize. But what we do is work on Saturdays and Sundays, and we do try to push to get your deals accepted before Monday when everybody goes back to work. And we do fully underwrite those pre-approvals to make sure that you can close in 2.5 weeks. And when you are out there bidding on these properties, you can be confident that you're going to close on time, and the sellers can be confident too. And that's what we do and what it's all about, right? Plan for credit hygiene, okay? my slide couldn't have said it any better. We have to have credit hygiene. We want to have on-time payments, balances less than 30%, minimize trade lines. And we know things happen, hardships happen. We can't do it all the time. But small things like if you have a business, getting business credit instead of your own credit when your credit is good. Because guess what? When you max those cards out in the business world, they don't report to your credit if they're really in the business name only and nobody sees it. Doing little things like say, hey, I am purchasing a dishwasher from Lowe's. It's $1,000. My credit limit is $1,000. So Lowe's, why don't you increase my credit limit to $2,500 while my credit is good? I'm gonna charge this $1,000. My credit is gonna now stay good because I'm not at maxed out on this credit card because I didn't allow you to max me out. I had a strategy that worked when my credit was good. What happens is we get in a situation where we start reacting once our credit is bad. And now we can't go backwards. But if we plan our purchases and if we plan things, it may be just as simple as having your loan balance increased or you moving and shaking things a little different. So that way you can still maintain that good credit. And once again, we'll save that for another Zoom. As always, if you guys want to get pre-approved and get a second opinion and know what is out there, you can definitely scan a get pre-approved. I am Loans by Natasha on Instagram. I am also Natasha Robinson on Facebook. I am on YouTube. I just got on LinkedIn today. So I'm definitely working my platform so that way we can have this information out to you. And coming up, I'm so excited. I am having my second annual Black Friday Wealth Symposium through my foundation, Building Dreams Foundation. I founded it in 2013. Busy doing mortgages with everything that happened. So I never really had a chance to work it. And this is our second year coming back on Black Friday. It is going to be a webinar this year. We have so many people and I don't want to miss a name, right? So definitely excited about State Representative LaShawn Ford, our city treasurer, Melissa Conyers-Irving, the one and only Pastor Jerome Glenn. If you did not know who Larry Jones is, he is the king of the stock market, and he is absolutely amazing. He started off just being a regular employee, and now he makes all of this money in the market. He even teaches one-on-one to all the NFL players, and he is coming to you guys free to teach you how to work in the stock market. And he's not selling you a course. He's giving you real live information. Nicole Wheatley, what an amazing person. I don't know if you know Ms. Jacqueline Howard, but she does a lot in finance. Mr. Brian Jackson with the taxes. And I did give everybody, and I got to give my last shout out to Ms. Marky Lemons-Ryo, queen of AI, coming to give all her synergy and energy. And we're going to have a really nice time. We are lining up a DJ for the mid show. You can grab drinks with your friends, hang out. Let's learn about wealth on Black Friday. It's free. You don't have to go stand in the lines. You don't have to shop. We're going to teach you how to make money on Black Friday, and we are doing that to you for free. So if you guys are not following me yet, please follow me. I am Loans by Natasha on Instagram, Natasha Robinson on Facebook. And I appreciate you guys listening to me tonight. I was thinking I was going to keep this down to about 45 minutes, but I'm so glad that we were able to keep you guys still on here. And thank you for all the questions. There's no such thing as a bad question. I appreciate you guys. And once again, I am Natasha Robinson, your loan officer, MLS number 332074. I see the hearts. Do I have any more questions? To my team in the background. Let's see. Thank you. Well, I have so right now, I've been working with a lot of clients, and I got a lot of clients that did need credit repair. And what I learned was that wasn't kind of what I did. So I have been interviewing individuals, and I work with a lot of different credit repair people, but currently I work with someone who is HUD certified. If you email me, natasha@gravate.com, I can share the information. That person can assist. They do a 15-minute free credit consultation with your client, they'll get a free credit report, and then they'll go over it with them. And my agreement with them is that if they can fix it themselves, they'll just tell them how to fix it themselves. But if they need a credit repair, then there is a fee for that. But for free, they'll do a 15-minute consultation. And I recommend all my real estate professionals to get on the 15-minute call with the client, because the client really doesn't know, you know, what the information means or what they need to actually do. And it at least help you align them like with their next steps. And then you could give them some accountability checks like, hey, did you sign up, or whatever the situation is. And follow us at our webinar, because we're probably going to be giving away some free credit repairs. We're working on dropping all the promos, but we'll probably have quite a few things we're going to be dropping on that day, so clients can utilize that to get to a better situation. And thank you for working with those clients, because I know that it's a lot of work, but everybody needs assistance and we want to get people to the right place. So on my channel and through my channel, you're going to find a lot of that. Miss Terry Cowser will be coming on, Sharice Pleasant, and we're going to be teaching clients how to fix their own credit if they don't have money. And like we said, how to work with the HUD certified and housing agencies, because they have a little more financial support to help them get funded. I need my music right now, you guys. Any more questions? Thank you, everyone. I really appreciate you guys. Thanks for hanging in and listening. And you guys have a great night. And we look forward to seeing you next time.